November 30th, 2022. A company called OpenAI released a chatbot called ChatGPT as a, quote, research preview. Within 2 months, it had 100 million users. That had never happened before. Not TikTok, not Instagram, not anything. Today, ChatGPT has 900 million weekly active users. OpenAI generates roughly $20 billion in annualized revenue. It is valued at $852 billion. It has raised more private capital than any company in history, over $58 billion before a $40 billion round in 2025 alone. By every conventional measure, OpenAI won the AI race. And here is the number that should stop you cold. In the first half of 2025 alone, OpenAI recorded losses of between $7 billion and $13 billion, more than $2 billion in losses every single month. So here is the question this video is going to answer, not what happened at OpenAI, everyone is covering that, but why the strategy that won the AI race applied inside a specific set of economic assumptions may be making it structurally impossible to win the business model. Because the people who built this company aren't incompetent, they aren't reckless, they are among the most technically brilliant people on earth. The strategy was correct, the assumptions were the problem, and that is a far more important story. By the end of this video, you're going to understand the specific mechanism, not the headline, the actual mechanism, that makes OpenAI's financial position not just difficult, but structurally self-reinforcing. The more successful ChatGPT becomes, the more money it loses. And I'll show you exactly why that is, and why it was not a mistake anyone made, but a correct decision inside a model that had 3 flawed assumptions baked into it. And once you understand those assumptions, you'll see they're not unique to OpenAI. They apply to every company building on top of large language models right now, including the ones you probably use. To understand what OpenAI actually is, you need to understand what it was designed to be. December 11th, 2015, San Francisco. A group of researchers and technologists, including Sam Altman and Elon Musk, announced the founding of OpenAI. The stated mission was not to build a product, it was to ensure that artificial general intelligence, AI that can outperform humans at most economically valuable work, would benefit all of humanity rather than a small number of powerful corporations. To signal this intent, they structured it as a non-profit. No shareholders, no quarterly earnings, no pressure to monetize, just $1 billion pledge and a research agenda. That structure held for 4 years. In 2019, OpenAI created a for-profit subsidiary. It called it capped profit, meaning investors could earn up to 100 times their money, but no more. The reason was stark. The computational resources required to build frontier AI were doubling every few months. A non-profit structure was financially unsustainable. They needed capital at a scale that mission-driven donors could not provide. Microsoft moved first, eventually committing over $13 billion and providing Azure cloud computing resources at a discount. The partnership gave OpenAI the infrastructure to build GPT-3, GPT-4, and eventually ChatGPT. And then November 2022 arrived. And everything changed in a way that, at the time, looked like a triumph. But embedded inside that triumph was the assumption that would become the fault line. Here is something that gets lost in the coverage of OpenAI. When ChatGPT launched in November 2022, OpenAI did not expect it to go viral. It was released by their own description as a research preview, a tool to gather feedback on a conversational interface they had been testing internally. Within 2 months, ChatGPT reached 100 million users. For comparison, it took TikTok about 9 months and Instagram about 2.5 years to hit the same milestone. The product had created a category that didn't exist before, and it had done so with a cost structure that was designed for a lab, not for 900 million weekly users. That gap between the product's success and the cost structure designed to deliver it is the entire story. In 2023, Microsoft invested billions more. OpenAI released GPT-4, a model that cost an estimated $79 million to train, roughly 10 times the cost of its predecessor. The performance jump was real. Users could feel it. Enterprise customers began paying. By the end of 2024, OpenAI was generating $6 billion in annual revenue. Subscriptions made up approximately $3 billion of that. API access another $1 billion. Those are large numbers. They are also, when you look at the other side of the ledger, almost irrelevant. Running OpenAI cost $9 billion in 2024. The compute cost to train models alone, $3 billion, exceeded the entirety of its subscription revenue. The compute cost of running models for users ate the rest and then some. It cost more to run the software OpenAI sells than it generated in total revenue before any other expense was counted. This is the structure that everyone was applauding as a success story in 2023 and 2024. And it was a success. The product was real. The growth was real. The revenue was real. The problem wasn't the product, it was the assumption underneath the product. Here's the thing, from inside the room, this made perfect sense. When OpenAI's leadership looked at their situation in 2022 and 2023, they were operating inside a model that had one central assumption at its core, that the ability to build frontier AI, the most capable, most powerful models, required extraordinary computational resources, and that only a small number of organizations in the world could afford those resources. Therefore, scale was a moat. The more you spent on compute, the better your model. The better your model, the more users. The more users, the more revenue. The more revenue, the more compute. The cycle was designed to be self-reinforcing. Sam Altman himself described the strategy in those terms. Massive upfront investment, years of losses, then a payoff that would dwarf everything that came before. OpenAI's internal projections showed the company expecting to reach $200 billion in annual revenue by 2030, projecting it would turn cash flow positive beginning in 2029 or 2030. The logic was coherent. Fund the most expensive research in history. Build models nobody else can afford to build. Capture the market before competitors can close the gap. Then monetize at scale. Every smart person in the room agreed. The data supported it. The growth supported it. But buried inside that logic was an assumption. And here's what they couldn't see. The assumption wasn't about models, it was about cost. OpenAI had implicitly assumed that building a frontier AI model, one that could compete with GPT-4, required hundreds of millions of dollars in training compute. That assumption meant that the moat was real. Google, Microsoft, and Anthropic could compete, but a Chinese startup founded in 2023 by a hedge fund, with 200 engineers and limited access to advanced chips, could not possibly close the gap. That assumption held until January 20th, 2025. On that date, a Chinese AI lab called DeepSeek released its R1 model. Industry estimates placed the total training cost at roughly $5.6 million, a number that, if accurate, represents a 10 to 20 times cost reduction compared to frontier models from OpenAI and Google. OpenAI's GPT-4 had cost an estimated $79 million to train. DeepSeek R1 matched or exceeded its performance on key benchmarks for approximately $6 million. The gap between those two numbers is not a technical footnote. It is the single most important data point in the AI industry's economics since ChatGPT launched. On January 27th, 2025, the trading day after DeepSeek topped the App Store, Nvidia lost $589 billion in market capitalization, the largest single-day loss in US stock market history. The market was not reacting to DeepSeek's product, it was reacting to what DeepSeek's cost implied about the entire assumption that underpinned OpenAI's strategy, that compute spend equals moat. Now, there's a second layer, and this is the one that makes the story genuinely structural rather than just competitive. Even before DeepSeek, OpenAI had a cost problem that was getting worse, not better, as ChatGPT grew. Here is the mechanism, and it's worth understanding precisely. Every time a user types a query into ChatGPT, OpenAI incurs a cost, the inference cost, the compute required to process the prompt and generate the response. That cost is real, measurable, and it scales directly with usage. OpenAI's inference-related costs quadrupled in 2025 alone, causing its adjusted gross margin to collapse from 40% in 2024 to 33% in 2025. The more successful ChatGPT is, the more users, the more queries, the more engagement, the more inference costs compound. The product's success is directly, mechanically connected to its financial losses. There is no volume threshold at which this resolves itself without a fundamental change in either the price charged to users or the cost of inference itself. OpenAI makes most of its money from a $20 per month subscription model. The company loses money on every ChatGPT interaction. The free version loses even more. The scale isn't a result of product market fit in the traditional sense, it's the result of a product priced far below its cost of delivery. From inside the room, this made sense too. Underpriced to capture the market, reduce inference costs as chip technology improves, raise prices once you own the category, standard platform economics. The problem is that inference costs are not falling on schedule. Every single company building on large language models is unprofitable, even those providing the models themselves. The cost of inference, everything that happens from when you put a prompt in to generate an output, is increasing, not decreasing. And the third layer is the one that makes the first two structural rather than just financial. OpenAI's governance is uniquely, specifically designed to make this problem hard to fix. When OpenAI created its for-profit subsidiary in 2019, it built a structure where a non-profit board sat above the commercial entity, specifically to prevent purely financial logic from overriding the safety mission. That structure was the reason the board fired Sam Altman in November 2023. The board removed Altman, citing a lack of confidence, and he was reinstated 5 days later following a reconstruction of the board. But the underlying tension it revealed never went away. The non-profit structure also meant that for years OpenAI could not freely distribute equity, could not do a conventional IPO, and could not raise capital at the speed a normal for-profit company could. It completed its restructuring into a public benefit corporation in October 2025. But not before burning through capital at a rate that required extraordinary external intervention. OpenAI has raised approximately $58 billion since its inception, including more than $13 billion from Microsoft. A $40 billion round in March 2025 was at the time the largest private funding round in history. At the end of March 2026, a new $122 billion funding round, notably involving Amazon at $50 billion, Nvidia and SoftBank at $30 billion each, brought the valuation to $852 billion. These are extraordinary numbers. They are also a dependency. The company requires external capital not as growth fuel but as operational survival. And the governance structure that was designed to prevent it from becoming purely commercial has spent years creating friction at exactly the moments when rapid commercial decisions were necessary. So let's hold all three layers together. OpenAI built a cost structure designed for a world where frontier AI required hundreds of millions in training compute, and a company proved that assumption wrong for $6 million. It priced its product below the cost of delivery, counting on inference costs falling before the losses became structural, and those costs have been rising. And it embedded its commercial operation inside a governance structure specifically designed to slow down commercial decision-making. 3 independent failure modes, all active simultaneously. Here is what the numbers look like in real time. OpenAI's own internal projections showed it expecting roughly $74 billion in operating losses in 2028 alone, the same year competitor Anthropic expects to break even. While Anthropic forecasts dropping its cash burn to roughly 1/3 of revenue in 2026 and down to 9% by 2027, OpenAI expects its burn rate to remain at 57% in 2026 and 2027. Those are not projections from critics. Those are OpenAI's own financial documents shared with investors obtained by the Wall Street Journal. To close the gap, Altman has committed to a level of infrastructure spending that has no precedent in the history of technology. Project Stargate, announced on January 21, 2025, is a joint venture between OpenAI, SoftBank, Oracle, and MGX, with a stated commitment of $500 billion over 4 years, $100 billion deployed immediately. By OpenAI's own revised estimates, the company targets $600 billion in compute spending by 2030. $600 billion in compute alone. The logic is the same logic that got OpenAI here. Spend more on compute than any competitor can match. Force the model quality gap back open. Restore the moat. HSBC analysts concluded that OpenAI likely won't make money by 2030 and still faces a $207 billion funding shortfall to power its own growth plans, which meant OpenAI needed a new source of capital at a scale that even its existing investors couldn't easily provide, which meant approaching sovereign wealth funds, which meant a $122 billion round anchored by Amazon, Nvidia, and SoftBank, which meant a valuation of $852 billion for a company that lost more than $2 billion every month in the first half of 2025. OpenAI announced in late 2025 it would introduce advertising into ChatGPT's free and low-cost tiers. The company that was founded explicitly to keep AI out of the hands of commercial interests, that spent a decade insisting its mission was the common good, is now selling advertising against its own product to pay for the compute costs of delivering it. The strategy is consistent. The assumptions have changed. And the gap between those two things is what this video is actually about. As of May 2026, OpenAI is the most heavily funded private company in the history of technology. ChatGPT has approximately 900 million weekly active users. Annualized revenue runs at roughly $20 billion. It employs over 3,000 people. GPT-5 has been updated to version 5.3. Project Stargate is actively building data centers across the United States at 7 gigawatts of planned capacity. And Elon Musk, the co-founder who pledged $1 billion to the nonprofit and contributed approximately $45 million, began trial testimony on April 28, 2026, in a lawsuit against OpenAI and Sam Altman, arguing the company had broken its founding agreement by prioritizing profit over public benefit. The company he helped found to prevent AI from being controlled by a small number of corporations is now valued higher than the GDP of many countries, structurally dependent on 3 of the largest corporations in the world: Microsoft, Amazon, and SoftBank, and is burning through capital at a rate that requires a new extraordinary funding round approximately every 12 months to remain operational. None of this makes OpenAI a failure. It remains the most capable and most widely used AI platform on Earth. The product is real. The technology is real. But the business model, the specific set of assumptions about how the economics of AI would resolve, is not working on the timeline that the strategy required. And the principle this story teaches is one of the most important in all of modern business. Let me show you what it is. There is a concept in strategy called a cost moat. The idea is that if you can make your product structurally cheaper to produce than any competitor through scale, through proprietary technology, through exclusive access to inputs, you can protect your market position not by being better, but by being less expensive to build. What OpenAI built was the inverse, a cost castle. A structure where being the best required spending more than anyone else. And the assumption, stated clearly in their investor documents, reflected in every product decision, was that the cost of frontier AI would remain high enough for long enough that the moat would hold until the revenue caught up. DeepSeek didn't break OpenAI. DeepSeek broke the assumption that the moat was time-stable. That's the fault line in this story, not the losses, not the governance, not the competition. The assumption that a cost structure designed for a world of expensive frontier AI would remain valid in a world where algorithmic efficiency was advancing faster than infrastructure costs were falling. What killed the business model wasn't a bad decision. It was a correct decision made inside a model that assumed the competitive environment would move at a certain pace. And that assumption turned out to be wrong by a factor of roughly 17. OpenAI spent $79 million training GPT-4. DeepSeek matched it for $6 million. That ratio is the fault line. Everything else follows from it. And here is what should make you genuinely uneasy about the wider industry. OpenAI is not alone in this structure. Every single company building on large language models is unprofitable, even those providing the models themselves. Anthropic, Google DeepMind, every startup in the enterprise AI space. The assumption that inference costs will fall before the losses become structural is universal across the industry. If DeepSeek's efficiency can be replicated, and the technical evidence suggests it can, then the cost moat that the entire AI investment thesis is built on is not a permanent feature of the landscape. It may be a temporary one. If this story stayed with you, the next video to watch is my case file on SVB. The bank that followed every rule correctly built a structure that made perfect sense in the environment it was designed for, and collapsed in 48 hours when one condition changed. The parallel isn't obvious. Once you see it, you won't be able to unsee it. But here's the question I want to leave you with. OpenAI's plan to profitability runs through 2029 and 2030. It requires $600 billion in compute infrastructure, a continued revenue growth trajectory to $200 billion per year, and inference costs falling to a fraction of current levels. Any one of those three conditions failing would reshape the entire plan. Which of the three do you think is least likely to hold? And what would the consequence be if it doesn't? Leave your answer below. I read every comment and I'll pin the most rigorous ones.